Welcome, everybody, to Fides Wealth Strategies Group Financial Moment, hosted by Dr. Chris Rand.
And Mr. Mark Gallo.
There we go, there we go. Today I want to talk about a less talked about diversification. I call it tax diversification.
Okay.
I think it's important we talk about tax diversification because, as we know, taxes change. It's nice to be able to have options when you take your money.
Mm-hmm.
You don't want to be in that situation in life where the taxes go up and an individual is forced to take it from one location. Or if the taxes go down, you can take it from a different location. I always like those kind of ideas.
So what would change taxes for somebody?
Well, income would probably be at number one.
Yeah.
Two might be whoever's in office at that point in time.
Okay, so the government.
The government,
might make a change. Okay.
they might make a change. It's always a possibility.
So I like to ask all my clients this question. I know you know the answer.
I don't know.
I think. We'll see.
Okay.
What's the highest marginal tax bracket we've ever had in the United States? And I'll give you a hint. It was higher than zero.
Yep.
It was less than 100.
It was less than 100. It's good. It's good. I'm going to go with what I usually do in school. False.
Oh, come on.
Yeah, no.
It's 94%.
94% is
Right?
crazy.
You think about that.
Yeah.
It was zero before we had an income tax. As high
1948?
as that range. I don't remember the year offhand, but somewhere in there, post World War II, as high as 94%.
Yeah.
Today it's arguably 37 plus 3.8%. But bottom line is it's a heck of a lot lower than 94.
Right.
Where will it be next year or the year after? Who knows, right? It's hard to say. It's changed a lot and will continue to change.
Well, and that's why I think this topic is important, because oftentimes we spend so much time talking about asset allocation and diversification, and I think we spend so very little time talking about tax diversification and the importance of that, because I do feel like that gives you a lot of financial freedom. So let's get into what tax diversification is. Here, go into all the different ways you can do it.
Well, really what you're talking about is the ability to control eventually how much I pay in taxes when I draw money out, right? So there's a lot of different types of accounts that you can do that in. We're comfortable with, and we all know and hear about 401k plans, 403b, 457 plans, tax deductible IRAs. They all fit into the same category of an account that you put money into pre-tax. So I get a tax deduction today off of my income, but I'm going to pay tax on that at some point in the future at some undetermined rate.
I believe the industry jargon is qualified account, means it's qualified for tax deferral treatment.
I guess you could call it, you could refer to it that way, a qualified account that you'll have to pay taxes on, most importantly, at whatever your ordinary income tax bracket is when you go to take the money out. Right. Now, the contra to that would be a Roth account. Roth IRAs are most common. You can get a Roth account now in many 403bs and 401k plans, where the contribution goes in after tax. So no tax benefit when you make the contribution, and if it's taken out properly, then it's tax-free.
Let's talk about properly.
Properly, generally speaking, as you're 59 years old,
right.
You've held it for the number of years that's required for the type of account that you have, usually 5 years.
Yep.
And then you've met it, and so you can make that tax-free withdrawal. And that's based on the current tax law today.
Yep.
Not to say that Congress won't change that in the future, but that's how it is set up. Think about this for a minute. Imagine an account where you had two different accounts, one that was taxable, one that was tax-free, and Congress decides to change taxes at the time when you're retired to something a heck of a lot higher than it is today. Wouldn't it be nice to have flexibility to pull from your tax-free bucket? Or let's flip that around and say you go into retirement and your tax bracket is a lot lower than it is today, and lower than you think it might be in the future. It's nice to have the flexibility to take from your taxable bucket.
Absolutely.
Right?
Yeah, you don't want to have all of your money in Roth, for an example, and then they go in and create a value-add tax. Well, then all of a sudden you're going to be a really big proponent for changing whoever the administration is in the taxes at that time, I would imagine. So it does give you those kind of freedoms, right? And then we have the blend. We have the blended account.
Just an after-tax account, not just a standard kind of account that you pay taxes on every year based on whatever the tax rates are. It could be a long-term capital gain, it could be a short-term capital gain, it could be a dividend, an interest, it could be a qualified dividend, could be ordinary income tax, whatever the type of income is that you're receiving, you're going to pay at that type of a rate, and that's something that you pay as it's received. But I think your point that you brought up earlier, Mark, was about diversification. What you're really talking about is having, basically these three different buckets that you can decide at the time which one is makes the most sense rather to
well, and obviously the younger you start in things like Roth, the more advantageous it's going to be for the investor. And it gives you that tax deferred with tax-free growth if taken out properly. Those kind of things are great to do. But it's also something to come around to come RMD time. You can take distributions from the right place. And so it keeps your taxes down. The theory is at the end of the day, you want to keep your taxes light. So that gives you more spendable income. That's the funny thing about when you're retired, you're not going to go make more.
Well, it's funny you say keep your taxes light, and really, I guess it refers to what year you want to keep them light. Because
Absolutely.
sometimes as financial planners, we're actually proponents of paying more taxes today to potentially save you more money long term, maybe over your lifetime. Where accountants, sometimes their blinders are on and they're so narrowly focused on reducing your income taxes today, maybe it makes sense to pay a little bit more today so you can save in the future. It's just all something it's good to talk about. It's good to evaluate your options, and make sure that you're thinking about taxes, I guess, right?
It's one of the many facets of financial planning that we need to get involved with.
Yeah,
so
that's a fair point.
Thank you for joining us again for the Fides Wealth Strategies Group Financial Moment. We'll be talking with you again soon.